Yesterday, something happened that almost never happens. Two of the world's most powerful central banks, the US Federal Reserve and the Bank of Canada, cut interest rates on the very same day by the very same amount. Both shaved 0.25% or a quarter of a point off their policy rates. Small on paper, but huge in symbolism. You see, when central banks move together like this, it's usually not by accident. It's because the global economy is sending a distress signal. The Fed is responding to weakening US growth and softer labor statistics, and the BOC is responding to one of the worst jobs reports that Canada has seen since the financial crisis. This isn't a move of strength. This is an admission of weakening demand. And nowhere will the fallout be more felt than in housing. But to understand why, we need to rewind a little bit and find out just how we got here. First, let's take a look at Canada's economy. Because Canada's economy isn't just slowing, it feels like it's unraveling in ways that kind of remind us of previous downturns. Over the past 2 months, Canada has lost 106,000 jobs, the steepest 6-month decline since 2009. Unemployment is at 7.1%, but the reality feels a bit worse. You have discouraged workers that are leaving the labor force entirely. We've seen people leaving the provinces and Canada for greener pastures. In fact, GDP contracted by 1.6% annualized in Q2. That's quite a bit more of a drop than the 0.6% that was expected. And I have to say, this is starting to get embarrassing on a per capita GDP basis. It's been flat since 2016. That's an entire decade that we're rolling into here when we compare ourselves to the US and other major economies. What's more, investment in machinery, equipment, and research and development has hit a record low as a share of GDP last quarter. The question I have here is, would our productivity be a lot higher if Canadian businesses didn't have to deal with the never-ending supply of temporary foreign workers or a neglected immigration policy? Because when you look at productivity, it has fallen in 15 of the past 18 quarters, or about the last 4.5 years. Compared to the US, Canada appears to be stuck. When we take a historical parallel, in the 1970s, the US looked strong on headline numbers until stagflation pulled the carpet from underneath them. Canada appears to be replaying that very same scenario. The bottom line is that the Bank of Canada didn't cut because things are needing a little bit of stimulus. It cut because the economy is fragile, more fragile than they're making it out to be. And Canada has always had housing as its pressure valve. So let's dive deep into housing then, and let's start at ground zero in Toronto. Condo inventory in Toronto is piling up. In the resale market, there's 6.5 months of inventory, and detached just hit 4.8%, detached hit 4.8 months. That's the highest amount for both since the 1990s. And that's not even considering unsold brand new inventory, which pushes it way beyond that. When you look at seasonally adjusted sales, they slipped 1.8% month over month across the greater Toronto area in August, and they continue to run at less than half of peak levels seen since 2021. Sales were up 2.3% year over year, which is some good news. This is due to relative strength in the detached segment here, but that's an awfully low bar because last August saw home sales print at a 25-year low. So it's not saying a whole bunch. Last month saw the second highest number of new listings hit the market of any August on record, next only to 2020. Likely due in part to many sellers who didn't sell in the spring or in the summer months coming back to the market to try again. And then we have to go to Gregor Robertson. Last week, the federal housing minister called the condo market in freefall. And he said, quote, "There's far too much condo product in both Toronto and Vancouver. That type of housing was overbuilt in recent years, and it's not selling in today's market." Didn't he oversee some of the largest construction projects of this exact type of housing when he was the mayor of Vancouver? It just seems like it's a very off the cuff sort of statement to say, like, oh, well, that's too bad, isn't it? Here's another quote: "The market is the market. It will go up and down." Thanks, Tips. Right now, it's going down, which is definitely helpful for people who haven't been able to afford homes. I don't think that it could sound any more elitist than that. And it's very frustrating to hear this from somebody, like I said, who had a major role in putting housing in this position in the first place. And we're hearing reports out of Toronto now that 1 out of every 35 listings are now in a power of sale situation. That's about 3% of the active listings. When you look at prices, they're down by 22.5% from 2022, and they continue to grind down and to the right. So what about yesterday's BOC cut? Well, it won't fix oversupply, and it actually might have an adverse effect. It may even prolong this downturn, as developers rely on CMHC-backed loans to hold unsold units. It feels like there's a bit of a shadow bailout taking place in real time, especially when you consider the hockey stick graph showing chartered banks providing interim construction lending. It's just gone through the roof. This feels like a structural correction, and the government won't speak to it the way that they should. For if the public ended up losing more confidence in them, the issue could get much worse. There's also more historical parallels taking place here. I mean, if you consider Japan's lost decade of housing oversupply, there was too much speculative product and not enough demand. And that feels very similar to where we are today. So what's my prediction then going forward? Well, from 2025 to 2027, it's likely condo prices will stay weak. Many investors will stay underwater and they will struggle to sell. But, and it's a pretty big but, in the 2030s, it's likely we'll see new completions absolutely collapse, causing severe undersupply as builders don't build into these timeframes, or certainly into these environments. The Toronto pre-construction condo sales were just over 35,000 in 2022, and today it's under 3,000. Single-family completions will likely tumble in 2026, but will lead to a tightening in the resale market over that year. By comparison, 20 years ago, there were close to 55,000 single-family building permits in Ontario. Today, we're down to 15,000, and it continues to drop like a stone. It's not great news for Toronto. Vancouver, when we look at Vancouver, it's not a whole bunch better, albeit a little bit better because of some geographical constraints and a bit of a smaller market. Vancouver sales ticked up 0.9% in August, but again, big picture, they remain 60% below peak levels. For reference, in 2021, we had just over 5,000 sales in a month. Today, dropping to just over 2,000 on average. The sales to new listings ratio has fallen below 40%, and every time that's happened, prices have continued to decline. And for reference, in 2022, that number was over 80%. Court-ordered sales are still flat, thankfully, at just under 1% of the resale supply. That really hasn't changed too much here in Vancouver, and hopefully that will stay the same. Months of inventory continue to persist at their highest levels since 2012 in both the condo and the single-family market. The home price index also fell by 0.5% in August, and single-family building permits continue to print fresh all-time lows, pointing to a steeper slowdown in construction activity and hence a future supply issue on deck. In the 1990s, there were 22,000 single-family home building permits. Fast forward to where we're sitting today in Vancouver, it's now at 4,000. Meanwhile, rental construction is surging. Vancouver will add 17+% to its rental supply in the next 2 years, and in Kelowna, it'll be over 33%. So when you combine that with population growth that is slowing, it means that vacancies will finally rise, something that hasn't happened in years in Vancouver. And if you caught my last video with Keaton, the property manager who owns Greater Vancouver Tenant and Property Management, mentioned that we were at 1.6% vacancy today. So I do suspect we will see that rise. which I think is a good thing overall for renters. So, what does that look like from a prediction over 2025, 2027? Well, I think renters will see some relief as vacancies will rise and more purpose-built rentals will come to market. In the late 2020s, like 2028, 2029, you'll see single family shortages deepen as permits will hit record lows in those years. And then likely in the 2030s, I think condo undersupply will resurface and we might have a different kind of affordability crisis, something similar to what we're seeing today. A lot of that will depend also on how well the dollar does and our economy and so on and so forth. Moving over to Alberta here, because Alberta has been the beacon of real estate hope in Canada. But even there, Calgary and Edmonton, their prices have started to slide. Calgary is down 4% year over year, and condos are down 6%. Edmonton has been slipping now for 5 straight months, and rental construction is exploding there. It's up 40% year over year. Calgary's rental stock should grow by 17%, and Edmonton's will grow by 9%. Population growth at 4% isn't even enough to absorb that. So vacancies could continue to spike well into the 1990s era that we've seen before, or the 1990s levels that we've seen before. The Bank of Canada, the BOC's cut, I should say, doesn't change the fact that these units are already in the pipeline. And in fact, it begs the question as to whether or not Mark Carney needs to build 500,000 more rental or affordable homes. I mean, we did just see them come out with a plan to build 4,000 homes at a cost of $13 billion or $3.2 million per home. I'm just not sure how that pencils when they're modular by their very nature and the crown land is being given. Who's getting all the money? Anyhow, I know what a $3.2 million home looks like in Vancouver, and it certainly doesn't come out of a modular construction factory. When we look here at the predictions of the short term, medium term, and long term, Alberta, the short term, you're going to see rising vacancies and softer rents. In the medium term, you'll continue to see price softness, especially in the condo market. The long term, you'll still have some growth, but only after this inventory clears. So how do we resolve all of this? What do the Fed and the BOC cuts really mean for housing? In the short run, borrowing will get slightly cheaper, which is good. Sentiment might improve to some degree. Some buyers will return, but in oversupplied markets, I don't think you'll see demand change by a whole bunch. In the medium term across the nation, rate cuts will slow the correction, but they won't prevent it. They may even delay the inevitable by keeping weak projects alive longer and having these people bleed out even slower, resulting in still the same outcome, but just with more pain. In the long term, once the oversupply, once the elasticity in the market has cleared, by the early 2030s, I think we face new shortages again, especially in family-oriented homes. Hopefully the multiplex project, like we've seen here in Vancouver, will put a dent into some of that. We need to see it across the nation. Missing middle housing isn't just a product in Vancouver, it's everywhere. So for Vancouver, we could expect 2 years likely of rental relief. I don't see it coming down anytime soon. I don't see that pressure coming down anytime soon. I think we'll be followed by renewed shortages in the detached and condo market, but that is some time away. For Toronto, it feels like a bruising decade for condos. Then it'll be undersupplied and we see a very different kind of marketplace. A lot of that will depend on what happens to immigration and what happens to financing for first-time home buyers, tax relief, all that kind of stuff. A lot of that, I think, we'll see some changes. For Alberta, the rental glut is in the near term and a recovery will happen later on. Here's the last thing I want you guys to think about. What's the real glue that's holding all of this together? It has been, and it always will be, our confidence in the marketplace, our confidence in housing, our confidence in the stock market, ultimately our confidence in our government. That confidence, if it breaks, the consequences go far beyond falling prices and stalling home construction. it risks a crisis of trust in the very institutions that Canada has. And let's be honest, with home prices that have soared far faster than wages over the last 30 years, with real purchasing power having eroded year after year, and many Canadians feel as if their elected officials have failed them, the erosion of trust in Canadian leaders and institutions is real. It's a slow leak, and it's threatening the whole system itself. It's evident. It's not all bad, because while rate cuts will feel like a gift, they're really a preemptive warning sign. A warning that the system is maybe a bit more fragile than we'd like to admit, and that fragility shows up in housing. When our confidence fades in our homes, in our markets, and in our leaders, we see erosion in trust in the whole system. But if we can get around this, if we can get really good leadership, I'm still willing to give Carney a chance here. If he can bring confidence back to Canada, bring investment back to Canada, bring productivity back to Canada, a belief in Canadians themselves to improve their own outcomes. If trust returns, then stability grows, and then opportunity will open up again, and foreign investment will come back. We have a lot to give, but we have to unlock what we have to give, and we have to stop taking these morally virtuous signals to the world and start getting to work. I feel as if we do that, there'll be all kinds of reasons for people to live in Canada and stay here, grow here, and prosper here. And it's an interesting breakdown of what we've seen over the last month. I hope, and I have some confidence that things will improve, but in the short run, I should say, it's going to be a bit of a fight. It's going to be a battle. But through the medium term and then into the long run, the markets will change. And if we get it right, hopefully they'll be more sustainable for all Canadians going into the future.